Okay, today we are going to focus on the last objective for Chapter 4, Financial Reporting and Analysis, and we're going to work on objective number 5, using financial ratios to evaluate a company's performance. And back in the beginning of this chapter, what we had indicated was that according to FASB, financial reporting seeks to provide us with information that is both useful and relevant to investors and creditors and other parties that might be making decisions about one of our companies, in order to be able to evaluate the business's ability to achieve its goals for profitability and liquidity, and how they're doing with regard to cash flow. So what we're going to do in Objective 5 is we're going to learn how to get a better understanding of our business and its resources and the claims against those resources by calculating and evaluating financial ratios that help us to look at how the company is doing with regard to its two major goals, first being liquidity and second being profitability. So we're going to start out by looking at a financial ratio that we're familiar with, the profit margin, which is just simply our net income divided by our sales. And it's really just looking at the percentage of each sales dollar that ends up in our bottom line. So how much of every sale ends up resulting in profit for the company. And we would take this ratio and calculate it, and then we would multiply this by 100 to turn this into a percentage. It's best reflected as a percentage. Our next evaluation is for our evaluation relating to profitability is for our asset turnover. And our asset turnover basically measures how efficiently our assets are being used to produce sales. So what we're going to do is we're going to take our net sales, and then we're going to divide it by our average total assets. And our average total assets are calculated by taking the ending balance of the previous year's assets, which then becomes the beginning balance for the current year, and adding them together with the end of year balance for the current fiscal year, or the current fiscal period, and dividing that by 2. We make that the denominator, and then we divide the 2. And this one is reflected as times. So whatever our calculation yields, we're going to end up saying that's in this case, 1.9 times. Our sales are 1.9 times our average total assets. Next up is an evaluation of our cash flow or liquidity. And this is measuring how much cash from operations is generated and turning into net income or into the bottom line. Okay, so this helps us to assess the operations of our company and see if an increase in sales, ultimately results in some turning it into cash. So really just kind of evaluating the cash flow in relation to the income statement components. Okay, so we're going to divide our cash from operations by our net income. And again, this is reflected as whatever the number is, in this case, 1.3 times. So in this case, cash flow from operations is 1.3 times their net income. Then our next ratio is going to be our debt to equity. And our debt to equity measures financial risk within the company. The more debt the company has in relation to its equity, the greater its financial risk is considered to be. Creditors and interest on debt must be paid on time by the company, regardless of how the company is performing. So that presents a risk for the company in that if they're unable, if they're not profitable and they're having difficulty paying their creditors, it is a problem for the company. A company does not necessarily have to provide dividends to its stockholders, but it absolutely has to pay its creditors. Okay, and so this calculation is your total liabilities divided by stockholders' equity. And this is, again, also, it's preferential to report this as 0.61x, but you can convert it to a ratio, a percentage as well, and reflect that as 61.4%. And then next we have our return on assets. And this measures how efficiently our assets are used in the business to generate income. It takes our profit margin and our asset turnover, our asset turnover ratio, and measures income, the important income producing components of a company's operations. So when we're looking at this, the profit margin in and of itself doesn't necessarily take into consideration the amount of assets that are needed to produce that income. So this ratio helps us to look at that. And again, this ratio would also be then converted into a percentage. So this particular one would be reflected as 9.4% return on assets. And then I guess with regard to this cash return on assets, this slide is just basically explaining how we get that average total assets, which is the beginning number and the ending number divided by 2. And the denominator is that average total assets calculation. Then we have our return on equity. And this is a measure of return to the shareholders. Obviously, if you're an investor in a company, you want to have a clear understanding of what you can expect in terms of a return on your investment. And so this gives you a measure of that. The return on equity will typically be a higher number than the return on assets because, typically speaking, total equity is less than your total assets because your assets are financed by a combination of liabilities and equity. Next up is evaluating our liquidity. And we use 2 different measures to help us evaluate our liquidity. The first is working capital. And the working capital is just the total amount of current assets less or minus the current liabilities. And that gives us our working capital number. And it just basically is a reflection of how capable the company is with regard to paying its current bills. So this is a way to express that coverage in dollars. And the next liquidity measure is our current ratio. And this is really just simply taking our current assets and dividing it by our current liabilities and telling us how many times our current assets cover our current liabilities. And then we would compare this, typically speaking, we would compare this and any of the other ratios to the prior periods for our company as well as to competitors within the industry. How does our company's ratios on any of these measures compared to other companies within the same industry. Those are called industry norms. And in this particular case, the current ratio is also expressed as times. So in this case, we see that our current assets are capable of covering our current liabilities by 2.9 times. And, that's a very comfortable margin. That's comfortable. We look for this particular ratio to be greater than 1. So we're looking for our current assets to cover our current liabilities by at least 1 times. But again, this would be dependent upon that coverage ratio would be dependent upon how the company has historically looked, as well as in comparison to its peers within the industry. So while our current ratio we're looking to have this be greater than 1, our debt to equity ratio that we looked at a couple of slides ago, our debt to equity ratio, we would look to have this be less than 1. So our total liabilities being less than 1. But again, depends on the industry. Some industries are highly leveraged typically, and then that would be what would be considered a norm in that particular industry. So for instance, high-tech companies are typically fairly highly leveraged because there's a constant need to invest in longer-term assets. And the same goes for companies in, say, like the trucking industry. There's a constant need to invest in long-term assets, and so they tend to be a little bit more leveraged. Okay. And then that is it for this particular chapter for notes. And if you have any questions, please email me. And otherwise, we'll be posting the end of chapter questions for the chapter. Thank you.